Good afternoon, everybody, and welcome to the LendIt Fintech Weekly News Roundup. My name is Peter Renton, Chairman and Co-founder of LendIt Fintech, and I'm joined by my good friend and colleague, Todd Anderson. How are you doing, Todd?
I'm good, Peter. How are you?
I'm doing great, and we have a special guest with us today, Shannon Ballow with Business Insider. How are you, Shannon?
Yeah, I'm well. Thanks for having me.
Okay, why don't you just give a quick intro about yourself, what areas, what you cover, and what you do at Business Insider?
Yeah, so I'm a payments and fintech reporter at Insider on the finance team. So we cover lots of fintech, cover all the major payment players in the payments world, and then the banks that are also doing fintechy things.
Right, and is it Business Insider or Insider these days?
It is Insider. So I write for the business section of Insider.
But it's businessinsider.com, right? Is that still the URL?
Yeah, so we never changed the URL for the business section because I imagine it's quite hard to do, but we did our rebrand within the last year.
Right.
But I won't fault anyone for still calling us Business Insider because that was a long-standing.
Yes. Okay, so let's get into it. We've got a lot of big news stories to cover. I thought we'd start with the news out of Goldman Sachs. I think it was yesterday. Goldman Sachs are acquiring GreenSky, $2.2 billion. GreenSky is an interesting company. They went public at $4 billion valuation back in 2018, and they sort of languished around a little bit, but they've never really gotten going. They never really had a good run on as far as on the public markets go. They've been profitable. They've been growing pretty fast, but their stock price was down. It was down like I think 70% or something. But now, anyway, it's jumped up because Goldman is acquiring at a premium. But they're saying here it's like it's kind of buy now pay later, but not really. They're not really going. I mean, there's probably some overlap with Affirm, but very little with the likes of Klarna and Afterpay. They're not really a retail buy now pay later operation. It's home improvement and some medical loans. But anyway, Goldman are now going to have it. I know you did a story on this, Shannon. So why don't you just give us a little bit of background that you discovered?
Yeah. So we actually chatted with Stephanie Cohen about this. I think a lot of the messaging from Goldman on the deal is it's really GreenSky's customer base that they're interested in. 10,000 merchants, mostly like contractors and construction small businesses. I think the idea is at the end of the day, for Goldman to build that like book of business would be very hard. So yeah, I think that's a primary thing. I'm hesitant to call it like a buy now pay later fintech deal because I think that term has certain connotations. It's not like they're doing retail; they are doing true lending. I think they do some revolvers, but mostly installments. But yeah, an interesting deal. It was a surprising one to see, to be sure.
Yep.
Yeah, it kind of feels like it came out of nowhere.
Right.
All of a sudden, they acquired GreenSky, and it's like out of left field. I mean, it just gets Goldman closer to Main Street more and more every day. So they've acquired other companies that they can just fold right into Marcus. Here's you said it, thousands of new customers, right, that they can fold right into Marcus. I mean, it's pretty radical the change Goldman's had the last couple of years after Lloyd Blankfein left to where they are now, and how much they've put into reaching the Main Street customer who's still on the the higher end of Main Street. But it's they've diversified away from trading and have created this Marcus brand, which I think is a real long-standing I wouldn't call it a fintech, but competitor to a lot of the fintechs out there. I mean, this is probably the biggest one outside of a regular Chase type. That to me, if I was a fintech, I'd be worried about Goldman more and more every day.
Yeah.
Yeah, totally.
They are very serious. And I'm trying to find it here. There was a quote from David Solomon that I thought was really interesting, basically talking about how Marcus is sort of the key to what Goldman Sachs is doing now, and that's really where they're focused. And and this is going to be folded in with that. I feel like Goldman Sachs continue to execute. I mean, they are, they haven't really made many major missteps since they've had this sort of push. I mean, Marcus launched in 2016. I know they had a little bit of underwriting issues in the first year or two, but apart from that, they have. I feel like they just continue to execute well, and that's what Goldman's really known for, I guess. Anyway,
interesting. Oh,
so let's move on to another really big story this week. Square announcing, basically pay with the Cash App. So, they've got tens of millions of Cash App customers, and they have millions of merchants on their platform that are taking payments through Square, sometimes through Square hardware, sometimes it's just software, but they are taking Square payments, and they haven't been able to connect the two. Well, they haven't connected the two until now, and they announced on Monday that Cash App users will now be able to pay with their Cash App account at the Square enabled merchants. And I know that this I feel like this got a bit of play, but I feel like it's such a big deal. This is a monstrously big deal that you're bypassing Visa and MasterCard and American Express. It's almost, we're seeing the creation of maybe it's a fifth payment network after the big three in Discover, and Square probably have always predicated, always sort of tried to be helpful to the smallest of small businesses, and those can pay pretty large merchant fees into Visa and MasterCard. So, I know that Shannon, you wrote about this many months ago, which I just discovered this week. So, this is not a brand new. Maybe you could just tell us a little bit of the background about this story that you wrote about several months ago.
Yeah, so the story we did was a story about some job posts that we saw at Square, where they're hiring folks to help them build what they're calling the most sought after payments network in the United States. And it's really, really interesting, right? Like, to your point, the size of the seller ecosystem and the size of the Cash App ecosystem are massive. Cash App grew so much in the last 18 months, and connecting those two and creating that kind of closed loop, as people call it, payment system is like very, very economically beneficial to Square. And like PayPal has similar ambitions with its Venmo for business accounts and things like that. I think what fascinates me about the Square and Cash App is just the brand that Cash App has been building, like, glow in the dark debit cards and like their merch launch and all those kinds of things, like the way they engage on Twitter. I think they've captured a young audience, and that, it could prove useful. Like, there's a whole cohort of Gen Z consumers who like they know what cards are and they're spending money, but they're not necessarily loyal to their credit cards yet. So right. Cash App could be, cool for them and more normal for them.
Mm-hmm. I think it's interesting that it's, we're kind of going back in time in some ways, that, they're creating their own system outside of some of the other systems. And you think of Apple and all the things they're doing, trying to keep people in their ecosystem. And it's like all of a sudden it becomes all these various networks that are kind of competing against one another. While people jump outside of them, the idea is, how do you keep them inside your network? I think Apple did a deal with a firm in Canada to test that out. And so to me, it's going to be interesting to see kind of how these things over time meld with the Visa, MasterCards of the world. Because, Peter, I think you said it either in the story or you said it the other day when we were talking. There's a lot of fees that Visa, MasterCard are now not getting if people are using and staying in this system. And then I'm sure Apple will have theirs and they'll bypass those fees that way. And then all of a sudden it's like fee income keeps getting hit further and further. And how do those companies then respond?
Yep. Yeah, it's not good news for Visa and MasterCard, and American Express for that matter. And I want to just add interesting timing with the Afterpay deal, because Square now is going to add on another 16 million. There'll be some crossover with Cash App, but a lot of 16 million users of Afterpay, and all the merchants on that side as well that can go into the Square. So it's like buying Afterpay, you can turbocharge this whole connectivity piece, and suddenly you've already got a pretty decent following. But then once this deal closes, you might be able to suddenly increase everything by like 50% pretty quickly. And that's so I really think. I mean, the thing that strikes me is that this oligopoly we've had for decades now in the payments networks is going away. I mean, I think there's going to be, I don't know. I mean, you talked about Apple. I mean, Amazon potentially. PayPal. There could be a whole bunch of. Mike Cagney's Figure. We're talking. That's another one that really is trying to create their own payments network. So you're going to have, instead of just 3 options or 4 with Discover, you potentially, I could easily see within 2 to 3 years, 10 or a dozen options, and it's going to be, is it a race to the bottom? Is it who's going to be the cheapest? And you go like with Figure, they're planning on a really low fee for merchants. So it's good. It's a good thing, because I've often thought that the 3% that American Express owns, or 3.5%, they don't. I mean, it's great that you can have to worry about fraud if you're, when you're using your cards. But boy, it's a hefty fee that the merchants pay, and I think it's going to be interesting to see how it all shakes out. Anyway, let's move on to more mundane topics, shall we? And let's talk about the CFPB. I thought this really caught my eye, because the CFPB here is basically saying that they've put forward a proposal that would require any small business lender that originates 25 or more small business loans. They need to submit data now on the race, sex, and ethnicity of the principal business owners. So as well as applicants that are denied credit. So this really is something that hasn't been done before, and of course there's a lot of people reacting to it, but it's just right now it's a proposal. They say it's been a decade in the making, but it feels like to me that it's scaring banks, because I think banks are going to be scared by saying, "Oh, we don't really lend to minorities when it comes to small businesses," and so there's a bit of pushback going on there. But
the banks want the data anonymized, basically.
Right?
Like, all right, community banks do this, mid-level or regional banks do this. They don't want to be called out. I mean, they even said it plainly in some of the quotes in the article, like, this is really going to throw us right under the bus. And advocacy groups are like, well, you need to be thrown under the bus, because these businesses who have been left behind for so many years are still not getting the capital, and PPP showed that didn't even work. And so in some cases it did, but for a lot of the banks, they didn't service these types of customers. They went right towards the customers that they knew and trusted the most. And so to me, I think something like this can only be beneficial largely. Now banks might, react negatively to that, but if it gets more money in the hands of people who deserve it, based on a variety of factors, then ultimately it's a good thing if more people get capital that they need.
Mm-hmm. Shannon, any thoughts on this?
Agree.
Yeah.
Yeah, I definitely PPP came to mind first, where I was like, we saw this, like small businesses that like my pottery studio, sent me an email being like, our bank is ignoring us, like help us. And it was crazy. And it also just makes me think of everything going on at the CFPB around financial data broadly, even with consumers. And, there's a hesitancy for banks to provide that transparency because of what it reveals. And I hope that transparency comes. So I do think it could be a very positive thing.
Yeah, I mean, really, it's just all we're trying to get at is more data, and if the banks want to hide that, that's shame on them, because I'm sure you might be in a niche where it's just really hard to lend to minorities, or because you might be, say, you're servicing the agriculture sector in the just doesn't have that many of that population around. So it's, but I mean, still, it should be, the data should be out there, in my opinion. Okay, so I want to talk about some lighthearted news, which probably has some interesting ramifications, and that is we saw the news briefly for about an hour. It seemed we heard that Litecoin was partnering with Walmart was going to be accepting Litecoin as a payment mechanism, and Litecoin, it just soared, the value of that, and then the Litecoin guys didn't know about it, and they said, well, maybe because they have an open API, maybe Walmart have grabbed our API and doing something with it. Walmart said, no, we didn't actually, and then it came crashing back down. But it's fascinating that it's probably not a good look for crypto in the eyes of the regulators, I don't think. But the trading volume tripled in the hour after the article went live, and it's really, it just goes to show, in some ways, I mean, there's some people who made a boatload of money on this move. They're probably going to go. The SEC is probably going to go after them. But anyway, it's
not a good time for this to happen for crypto, with how heavy-handed they're about to get and are starting to get with crypto. And it just seems like there's a split in the community, where there's the piece that the Winklevoss twins and those that want to play in the system, Caitlin Long of Avanti Bank, that want access to the system. They want to make the system more efficient, more fair. And then there's the piece of the crypto community that don't want to be in the system, and they want to keep it outside the system. And I think those two things are still at play right now. And you have this constant push and pull as the regulators are just coming over the top, trying to hammer the industry. And this is, just another example that they can throw in front of Elizabeth Warren types to say, give us more power to regulate crypto because it's not safe. Investors will lose money. It's pump and dump, and it's all this stuff. So I think it's not good for the long-term prospects, at least right now. And they need to be more careful.
Yep. Yeah, I feel like the Caitlin Longs of the world are just cringing when they see stuff like this, because they are the ones that are probably going to be, they're trying to do this the proper way through conversations with regulators, being open, and it's these people are just keep sort of giving them a bad name, and it's rough. Anyway, let's move on to another story, and like another SPAC. We haven't talked about SPACs in weeks. It's probably been, I don't know, 4 or 6 weeks since we've talked about SPACs. But we're talking about them now. Pagaya, which is Pagaya Technologies. They been involved in the fintech space for some time, particularly on the loan buying side. They're doing a SPAC. $9 billion SPAC. I thought, wow, I did not think they were that far along, but it's going to be a big deal. They're going to go public via a SPAC. EJF Acquisition is the name of the SPAC, and they like Pagaya. We've had the CEO speak, I think, several times at our event, and like the whole thing is they use this AI kind of technology to analyze all of they've basically what they really started off with was consumer loans at Lending Club and Prosper and other places, where they would just use their AI to really find the loans with the highest probability of just the best value, and that's what they've done. But who'd have thought it? $9 billion SPAC, huh?
It's like insane is I see the number 9 billion and like just glaze over it.
Right. I know. That
it is scary.
It is. I mean, like, yeah, that's just a crazy it's a crazy world we live in the fintech space, it seems. Yeah. Okay. Well, anyway, let's move along. I want to talk also now about Stripe, because This happened actually. I think it was late Friday when this. I feel like Stripe has been in the news every 2 or 3 weeks. There's another little tidbit, a little crumb of news that sort of leaks out or that Stripe shares about their IPO. And now we find that they're talking with bankers about a 2022 IPO. I mean, this is going to be potentially, I'd say probably, the biggest fintech IPO in history. It is, Ant Financial or Ant Group still hasn't gone out public yet. That they were going to hold that mantle. God knows what's going to happen to them with them being broken up into multiple pieces, but that's a whole nother story. But they've also said they may go public via a direct listing. But Stripe, every single time they make another step, this is going to be front page news in the fintech space, don't you think?
100%. Yeah, no, Stripe. I think they're interesting. They're like a pretty buttoned up company. So when things do come out, I think people get very, very excited. They're just a very measured, and it's even beyond their PR and their outreach. I think everything they do is very measured and careful. And so there's not a Stripe out there except for these little crumbs, as you put it, which is interesting.
Yeah, and I can only imagine what the valuation will end up at. I mean, it's
already monstrous. I mean,
it was close to 100 billion already.
Yeah,
you're easily seeing that be inflated significantly from there by the time they get to actually wanting to list.
I mean, can you do a 200 billion IPO? I mean, that's. I mean, I guess you can, but I mean, I feel like that means is Stripe. I think people are betting on Stripe. Is Stripe going to be the next $1 trillion company? Are they going to be the first $1 trillion fintech company? Square could be, PayPal could be. PayPal will just continue to just be on a tear, it seems. But one of them, I mean, I fully expect there'll be a $1 trillion fintech company. 2 years, you think? 3 years, but it's going to happen.
I don't know if that's soon, but it will happen.
Yeah, maybe 5 years. But I mean, I think what's PayPal like? PayPal's got to be like 300 or 400 billion. So it's not. I know there's only a small number, but soon $1 trillion companies will be all over the place. But
it'll all come crashing down.
I don't know. I mean, you look at the PE ratio of companies like Apple aren't that high, and they're a multi-trillion-dollar company. So
yeah, that's true.
Anyway, but want to talk about our good friends over at QED. QED investors, Nigel Morris and Frank Rotman and company have just now they've closed on 2 new funds, $1.05 billion. They were in many ways they were ahead of their time. They started focusing on fintech investing back in 2008. When they launched, they've done some pretty amazing Series A's where there was, you're talking about, low double-digit million valuations, like $10 million, $15 million valuation that became unicorns many times over. So they've done some really great work there. They're focused here. They're focused in Latin America, Europe. And increasingly in Southeast Asia, they actually have 20 unicorns in their portfolio right now, which is pretty amazing. And they started with $30 million of their own internal capital. I mean, Nigel Morris made a huge fortune at Capital One as he was the co-founder and CEO there for many years, and parlayed that. Now, I'm sure they've put that 30 million many times over. It's now they got $3 billion under management, was 100x, but they've obviously had other funds launched since then. But I'm a big fan of QED. Frank Rotman had a great Twitter thread earlier this week talking about what he's learned in his basically a summary of his wisdom gained since they launched, and it was a great read as well. So kudos to QED.
You'd probably find it hard to. Oh, sure, go ahead.
There's just so much so much money in fintech, and like they talk about, I think in the TechCrunch piece, there are 40 or 50 early stage companies, and I'm like, what are the next 40 to 50? Like fintech has matured so much, but like there's still so much energy in early age, which is really interesting to me.
Especially now, post-COVID, you think all the ideas that are milling in people's heads, and these next couple of years are just going to be the second wave of fintech, especially with so many more people coming online to have to interact with their financial lives in a more digital way. And I think the one interesting thing about QED is that they're a lot less flashy than some of the other funds out there.
Right.
So you don't get as much public talk about QED, though they're probably one of the more consistent performing funds out there. Like maybe Andreessen or Sequoia, make significant bigger splashes. Not that those firms are doing a bad job, but QED it kind of tends to fly under the radar a bit more.
They don't toot their own horn. They really don't. I think they let the numbers. Clearly they can raise money. I mean, they've and I don't know who.
And anytime Frank does one of those, like Twitter, it's usually on a subject. It's not like, hey, here's 20 portfolio companies. It's hey, here's advice for founders to do this or that, or here's something that you can take away from it. It's just not. Yeah, it's they're consistently one of the best out there.
Right. And I've heard yeah, I mean they're
fintech Twitter.
Yes, seriously. That I feel like with QED, they got in early. They've just let the numbers speak for themselves, and I think what the people in the VC community all love QED, and that's, I think everyone knows them. They many of them partner. When QED leads, it's sort of a big stamp of approval on that company. And as you say, Todd, I mean, they've got a $500 billion. It was a $500 million. Sorry. $500 million seed fund or early stage fund. I shouldn't say seed. Early stage, and then a $550 million growth fund. And it's, I look at it and you think, well, fintech's just been on this tear and the valuation's ridiculous. But then you think, well, there's so many interesting things happening in fintech today that there's going to be massive companies that will be created that will be multi-billion-dollar valuations at the end of the decade. That is still just an idea in someone's mind right now, because I think there's so many areas of fintech that are still, not only that, I feel like they're still underdeveloped in some ways, and then you've got all the new things that are going to be built on. Like there's a central bank digital currency that is launched in this country. Imagine all of the things that are going to be bolted onto that, and that will be able to kind of be more is the whole ecosystem that we built around those things. So anyway, we're getting off track, and we're almost out of time. So last story I want to touch on is Curve. This just came out today, which I thought was really interesting. I'm a big fan of Curve. They're a UK-based company coming to the US. I'm on their waiting list. Basically, the whole premise is you don't need to carry around multiple credit cards. You just carry around the Curve card and the Curve app. And then if you want to go and actually physically use your card, you choose in your app which card you want to use. You can have like 20 credit cards and just choose which one you want to use, and you go and physically hand it to somebody, and that's the credit card that you're using. And so it's a brilliant idea, and now they're getting into credit, which we've known about for some time. But this new product, Curve Flex, it's only available in the UK right now, but it's basically going back and looking at your last 12 months of purchases on your credit card, and you can convert any one of them into an installment loan. And it's their take on buy now, pay later, and I think it's going to be popular. People love the buy now, pay later. They don't really like paying on credit card. Let's take that lump sum from Curve, pay off the credit card, and away you go.
Yeah, that's really interesting. I wonder. So Curve. I'm not too familiar with them, but it sounds like people talk about, the wallet will disappear, which I'm very skeptical of. I think I'd feel weird not carrying around a wallet, but I wouldn't mind just carrying one card and my ID. So
well, your ID is going to be on your
wish we were
phone
doing
very
like that.
soon. I mean, my Colorado, I just put my driver's license on my phone just in the last month. But so it's going to be your phone. But yeah, you might want to you don't need to have a credit card. There are still some places that actually don't take the Apple Pay or Google Pay. So you do have to use it.
Yeah.
We're moving in that direction though.
Yep.
And it's it's making it easier in one sense, but it's also a bit tricky in another. At the same time with Curve, where it's like, you feel as if you don't have a lot of credit cards when you actually do at times. If you kind of use that as kind of your, and all of a sudden you can look and you can have a lot more credit on your report than maybe you thought you did.
Right. Yeah. Everything's invisible.
Yeah.
And it sounds like they're going to be competing. Like really, it's going to get to a stage where they're going to compete with Apple Pay or the Apple Pay wallet and the Google wallet, because that's kind of it looks like where they're heading. Anyway, we have gone over time, and we would like to thank our guest Shannon Ballow for her insights. Thank you, Todd, as always. Thank you to the viewers. Have a great weekend, and we'll be back same time next week.
Thanks.
Bye, everyone.